It plummeted like 32% from its January highs, yet the most sophisticated institutional money in the market is quietly pouring literally billions into it.
Right.
So is the iShares Silver Trust currently this massive structural buy, or are retail traders just, walking blindfolded right into a classic value trap?
I mean, you are watching the ultimate tension in the commodities market play out in real time right now. It is this brutal tug of war between undeniable physical scarcity and just wild paper market volatility.
Yeah. And if you were trying to figure out which side of that rope you're standing on, you were in the exact right place.
Exactly.
But before we dissect the bull and bear cases, the dark pool order flow, and, well, the looming threat of industrial substitution, we need you to like the video, subscribe to our YouTube channel, and it is compulsory to leave us your feedback in the comments. We actually use your insights to literally shape the direction of these deep dives, so get in there and tell us what you're tracking.
Oh, yeah, we read them all.
Yeah.
And speaking of tracking, as we tear into this data, we need to establish the ground rules. Right. We are looking at professional analyst ratings, deep tier options flow, all the granular market mechanics. But this deep dive is strictly for educational purposes. We are not financial advisors. This is not financial advice.
Right.
We're just decoding the raw data to help you understand the landscape.
Yeah.
How you navigate that is entirely up to you.
Yeah, we bring the magnifying glass, you make the decisions. So let's establish the baseline. Today is Tuesday, April 21st, 2026, and our mission today is to unpack the violently conflicting signals surrounding the iShares Silver Trust.
Ticker symbol SLV.
Right, SLV. We have a massive stack of sources today. But, to understand where SLV is going, we have to look at the absolute whiplash it just put the market through.
I mean, whiplash is definitely the correct term. The 52-week volatility we are seeing here is just historic.
It's crazy.
Yeah. If we rewind to May of 2025, SLV was languishing at this low of $29.04. Then fast forward to January 2026, just a few months ago, and we saw this parabolic surge to an all-time high of $109.83.
And then the floor completely vanished. Like just a brutal 32% crash from those January highs brings us to where the asset sits right now, which is trading at $72.15 as of the April 20th close.
Right.
Now, anytime an asset bleeds 32% of its value in a matter of months, the immediate instinct for any value investor is to, look under the hood. You want to pull up the 10Q.
Naturally.
You want to look at the quarterly revenue, the earnings per share, the debt-to-equity ratio, just to see if the sell-off was an overreaction to fundamentally strong financials. But you can't do that with SLV.
You really cannot. I mean, if you are digging through SEC filings looking for an income statement or like a profit margin for the iShares Silver Trust, you are fundamentally misunderstanding the vehicle you're driving.
Okay, let's unpack this. Because looking for SLV's traditional quarterly earnings is basically like looking for a car's engine in the trunk.
Yeah, that's a good way to put it.
If someone is digging for an EPS or a debt-to-equity ratio here, why are they looking in the wrong place?
Well, because SLV is not a company.
Right.
It doesn't manufacture anything, it doesn't have a marketing budget, and it certainly doesn't generate quarterly revenue. Its entire structural design is simply to exist as a vault.
A vault.
Yeah, it's a grantor trust, which is an ETF whose sole purpose is to hold physical silver bullion. The value of SLV is 100% derived from the spot price of physical silver on the global market. There is no corporate income because it just sits there.
Okay, so all the traditional metrics that value investors rely on are completely irrelevant here.
Yeah.
We have to look at entirely different indicators to gauge the health of this asset.
Exactly. The first metric you look at for a physical commodity ETF is its scale and liquidity, which means looking at AUM assets under management.
Right.
Right now, SLV is sitting on an astonishing $39.04 billion in net assets.
Wow. That's massive.
It is. That tells you the sheer gravity of this fund. Yeah. It's a behemoth that institutions rely on for deep liquidity. And the second crucial metric is the expense ratio, which is 0.50%. That is essentially the management fee, the trust charges, to cover the logistical nightmare of securing, auditing, and physically storing billions of dollars of metal in actual vaults around the world.
Right, because we can't look at a PE ratio to see if the business is healthy. The only way to gauge SLV's momentum is to look at the footprints of the people accumulating the metal. We have to follow the money.
Yes, absolutely.
So if the price just dropped 32%, who was actually stepping in to buy the dip and who was fleeing?
Well, the institutional activity over the last 12 months tells a very definitive story about where the smart money thinks the floor is. The data shows institutional inflows hitting $2.77 billion, while outflows were only $1.26 billion.
That is a massive discrepancy. I mean, we aren't talking about retail day traders throwing money at a meme stock here.
No, not at all.
Our sources note major institutional holders taking massive positions. We're talking heavyweights like JPMorgan Chase, Susquehanna, and Citadel.
Yeah, and if you look beyond the equity shares and into the derivatives market, the options flow data confirms that institutional bias.
What are we seeing there?
We're currently seeing a massive 70% call bias. The professional options traders are aggressively targeting the $75 to $77 range.
Oh, wow.
They're putting serious capital behind the thesis that this current chop in the low 70s is a launching pad, not a permanent ceiling.
Okay, wait, let me push back on this institutional optimism for a second. Because there is another data point in our sources that seems to throw cold water on the idea of an explosive rally.
Okay, what's that?
Short interest.
Ah, right.
The data shows that short interest just fell 18.2%. It is now down to 35.33 million shares, which represents just a measly 6.2% of the float.
Yeah.
And the retail crowd usually relies on high short interest to trigger those violent January-style squeezes. So if big money is so bullish, doesn't the declining short interest actually kill the chance of a massive, explosive retail short squeeze? Is the easy money already made?
What's fascinating here is that it actually changes the entire structural dynamic of the trade. You are right that a 6.2% short interest effectively neutralizes the threat or the opportunity, depending on how you look at it, of a violent short squeeze.
Right.
The artificial fuel that drives a stock up 40% in a week simply isn't there anymore. But for an institution like JPMorgan or Citadel, a lack of a short squeeze is actually a feature, not a bug.
Really? Why would they prefer slower growth?
Because institutions deploying billions of dollars cannot risk parking capital in an asset that swings wildly based on, Reddit sentiment and forced covering.
Oh, that makes sense.
Yeah, they demand structural growth. When short sellers cover their positions and leave the market, it indicates that the broader consensus believes the downside risk is exhausted. The declining short interest means the market is returning to a state of equilibrium based on actual supply and demand. The artificial meme stock volatility might be fading, but the institutions are betting on a sustained, macro-driven upward trend.
Well, if the big money is betting on a sustained trend, we need to look at the actual architecture of that trend. Let's pivot to the technicals. What are the charts telling us about the timing of these institutional buys?
The current chart momentum is really defined by a broad consolidation phase. Over the last 2 weeks, we've seen a neutral to slightly bullish short-term trend, with SLV up 9.17%.
Yeah.
It's basically trying to establish boundaries after that brutal drop.
And what specific boundaries are we looking at?
So the data points to immediate support at $71.18 and then $70.13. But the critical level, the hardened psychological floor, is sitting at $67.73.
And, a psychological floor isn't just a random line on a chart.
No, definitely not.
A level like 67.73 usually represents a historical volume shelf. It is the specific price where, historically, institutional buyers have aggressively stepped in and said, this asset is fundamentally too cheap to ignore, and that creates a wall of buy orders that halts the sell-off.
Exactly. That is where the buyers live. And on the upside, the immediate resistance it needs to break is $72.44, but the massive long-term technical ceiling is looming at $78.50.
Okay, so a decent ways up.
Yeah. And to see if SLV has the kinetic energy to challenge that ceiling, we have to look at the momentum indicators.
Well, I'm looking at the 14-day RSI right now, and it is sitting dead center at 49.91.
Completely neutral.
Right. It's like a sprinter catching their breath. The asset has entirely flushed out the crazy overbought conditions from January. It's just treading water.
Yeah, the tension has reset. But the MAS CD, the moving average convergence divergence, is where the technical picture gets highly nuanced.
How so?
The overall MATD is at 0.310. Which technically registers as a buy signal. However, the analysts in our sources are flagging negative histogram shifts on the shorter time frames.
Okay, wait. If shorter time frames show a negative Mansi shift, are we looking at short-term weakness masquerading as strength?
It's a hidden divergence. So the MATI histogram tracks the distance between the short-term and long-term moving averages. When that histogram shifts negative, it means the gap is narrowing.
I see.
The actual velocity of the buying pressure is decelerating on a day-to-day basis, even if the overall price is still inching upward. It basically indicates institutional hesitation.
So they're cautious.
Very. The trauma of the 32% crash is still embedded in the market psychology, and buyers are reluctant to chase the price higher right now.
So the short-term momentum is stalling. But the overarching macro trend, the moving averages, tell a different story.
A significantly different story. Despite that short-term deceleration, the technical experts maintain a strong buy on the moving averages.
Why is that?
The reason is structural. SLV is currently holding firmly above its 50-day simple moving average at $71.09. And more importantly, it is miles above its 200-day SMA, which is anchored way down at $68.64.
And the 200-day is the ultimate line in the sand for macro investors.
It really is.
As long as an asset is trading above that 200-day average, the long-term fundamental trend is considered intact, regardless of the daily chop.
Yes. Staying above the 200-day indicates that the overarching macroeconomic sentiment remains overwhelmingly positive.
Which brings us to the core tension of this entire deep dive. The charts show consolidation above the macro trend lines. The options flow shows institutions betting on a breakout. But to figure out if SLV will actually shatter that $78 ceiling or collapse through the $67 floor, we have to move beyond the charts and debate the fundamental drivers.
We do.
We have to answer the question, is the physical asset actually undervalued? Or is this ETF a carefully disguised trap for retail investors?
Well, the analyst community is fiercely divided on this, and both the bull and bear arguments are grounded in undeniable structural realities.
Let's start with the optimists. The consensus rating across our sources leans toward a hold with a bias toward buy.
Right.
The bull case is anchored in the physical reality of the metal. Analysts point out that we are entering our 6th consecutive year of physical silver deficits. For 2026 alone, they are projecting a supply deficit of 46.3 million ounces.
That's massive.
The global economy is physically consuming more silver than the mining sector is pulling out of the ground.
Scarcity is the bedrock of any commodity supercycle.
And you combine that scarcity with an 18% growth in investment demand, largely driven by ongoing geopolitical tensions. Specifically, the conflict involving Iran is pushing a lot of capital into safe haven assets. But the real heavyweight in the bull thesis is the industrial sector, the massive secular tailwinds of electric vehicles and high-efficiency solar panels.
Exactly, because silver is the most highly conductive metal on the periodic table. The modern green economy cannot scale without it.
Right.
Every EV battery management system, every photovoltaic cell relies heavily on silver paste to function at commercial efficiency. So that's the bull case. An immovable industrial necessity colliding head-on with a persistent multi-year supply deficit.
Sounds like an airtight thesis. But the bears have some incredibly sharp teeth in this debate, starting with the structural risks of the ETF itself. If you buy SLV in a standard brokerage account, you are not taxed like a normal stock.
No, you are not.
The IRS classifies this asset as a collectible.
And this specific tax classification destroys the profit margins of so many unaware retail investors.
Is brutal. Because SLV is a grantor trust holding physical bars, the IRS essentially views your shares as owning a fraction of a physical silver bar. You are penalized as if you were storing rare art or vintage coins in a vault. You don't get the standard 15% or 20% long-term capital gains tax rate. You get slapped with a massive 28% collectibles tax on your profits. It structurally degrades your upside.
It really does, and that tax burden compounds the second major risk the bears point out, which is the historical behavior of the asset itself.
Oh, the volatility.
Exactly. The 32% drop since January proves that silver retains its vicious cyclical volatility. It has a long history of explosive, euphoric rallies that trap retail traders who suffer from FOMO by the absolute top and are then just left holding the bag when the massive institutions suddenly liquidate and take profits.
Yeah, but here's where it gets really interesting. The most fascinating bearish argument in our sources, the one that actually threatens the core, the fundamental bull case, is the concept of thrifting.
Ah, thrifting. Yeah, that is the ultimate counterweight to the industrial demand thesis.
The argument goes like this. The bulls rely on solar panels and EVs requiring massive amounts of silver. But if the price of silver stays in the 70s or shoots back past 100, the manufacturing cost becomes completely unsustainable.
Right.
So won't these massive industrial conglomerates simply engineer silver out of their products?
Yeah.
If they substitute it with cheaper alternative materials, doesn't that massive industrial demand just vanish overnight?
That is the exact mechanism that divides the analysts. It's the tension between the thermodynamic necessity of silver and the corporate mandate for cost cutting.
But how realistic is that substitution physically? I mean, can you just swap silver for copper in a solar panel?
You can, and engineers are spending billions trying to perfect it. They use techniques like copper plating to replace silver paste. But there is a massive engineering trade-off.
What's the catch?
Copper oxidizes differently. It degrades faster, meaning a solar panel loses its commercial efficiency over a 20-year lifespan. So the bull argument is that the efficiency loss of thrifting is far more expensive than simply paying higher prices for silver.
But the bears point out that there is a breaking point.
Exactly. There is a specific price threshold where the mathematical reality flips. If silver becomes too expensive, industries will accept the efficiency loss just to protect their margins.
Wow.
So, is SLV a value trap? Well, if you believe the solar and EV industries will rapidly and successfully thrift silver out of their supply chains, then buying at these levels is a massive trap.
Right.
But if you believe the physical properties of the metal make it irreplaceable and the supply deficit will persist, then even at $72, it is fundamentally undervalued.
Okay, so synthesizing all of this, the missing traditional financials, the billions in institutional call options, the deceleration in the MACD histogram, the 28% IRS collectible tax, and the looming engineering threat of thrifting. What is the actual outlook going forward?
Well, the immediate outlook is bifurcated. In the short term, over the next several weeks, the data suggests you should expect choppy consolidation.
Just bouncing around.
Yeah, SLV will likely bounce violently between that $70 support floor and the $75 resistance band. The market needs time to digest the recent volatility and wait for a definitive macroeconomic catalyst, either a break in the supply chain or a major shift in industrial demand.
And the long-term perspective.
Long-term, the analyst targets remain heavily biased to the upside. Driven by the sheer weight of that physical deficit, the consensus price targets for physical spot silver still sit around $81 an ounce.
Oh.
If we translate that to the ETF, it puts a long-term target for SLV roughly in the $78 to $80 range.
Which would require a definitive, high-volume breakout above that massive 78.50 technical ceiling.
Exactly.
Now, one final reminder before we wrap up. We have mapped out the support levels, the tax traps, the institutional targets, but everything we discussed today is strictly for educational purposes.
Yes, absolutely.
We are decoding the market mechanics, not offering financial advice. You must do your own fundamental research before exposing your portfolio to an asset with this level of historical volatility.
Because diligence is the only defense in a market this aggressive.
Yeah. But, we have spent this entire deep dive analyzing the iShares Silver Trust in complete isolation. We looked at its specific inflows, its specific moving averages, its industrial supply chain. But in the commodities market, looking at an asset in isolation is often only half the equation.
It almost always is, because while you can build a massive thesis on supply deficits and SED shifts, the ultimate historical test of silver's valuation is entirely relative.
Right.
It is a relationship that has dictated global markets for literally thousands of years.
I think I know what mechanism you're about to bring up.
Yeah, if you are trying to determine if silver is truly undervalued or if the current price is a trap, you have to ask yourself, have you looked at the silver to gold ratio recently?
The ultimate historical tether.
Precisely. Silver and gold are fundamentally linked in macroeconomics. When that specific ratio stretches too far out of its historical norm in one direction, market forces almost always cause it to violently snap back.
Wow.
So if you want the final piece of the puzzle regarding SLV's true value, that ratio is where you need to look next.
That is a phenomenal reality check to end on. We started this deep dive looking for a traditional PE ratio, and we end up needing to analyze an entirely different precious metal just to understand the baseline valuation.
It's all connected.
It really is. That silver to gold ratio is absolutely something you should pull up on your charts right now. Let that data percolate, do your own digging into the historical averages, and let us know what you uncover in the comments. Thanks for joining us, and we will catch you on the next deep dive.